This week on Wealth Track, when great investor Michael Hassenstaub searches the globe for bond opportunities, he now hops on a plane and heads towards Asia. Morningstar's fixed income manager of 2010 is high on the bonds and currencies of emerging markets, but gives a thumbs down to the U.S. Templeton Global Bond Fund's Michael Hassenstaub is next on Consuelo Mack Wealth Track.
The company you keep is also the company we keep. Together we help provide a lifetime of guaranteed income and investment solutions.
Additional funding provided by Luma Sales, investors seeking exceptional opportunities globally. Research affiliates, an efficient index for an inefficient market. Wintergreen, your home for global value. Rosalind P. Walter, and the Dreamin Foundation.
Hello and welcome to this edition of Wealth Track. I'm Consuelo Mack. If you think long-term, as we and our guests try to do on Wealth Track, you know the handwriting is on the wall, challenging the primacy of the U.S. dollar in world affairs. Unless the U.S. gets its fiscal and some would say monetary house in order, the value of the dollar and U.S. Treasury bonds in particular will be under attack. The battle has already begun. Recently, Standard & Poor's very publicly downgraded the outlook for U.S. debt to negative. And China recently decided to allow more renminbi-based financing for foreigners. One more step along its currency's path to world markets. Then there are the shifts you don't hear about. The money that is or has been moved out of treasuries to other countries. This week's great investor guest, Templeton Global Bond Fund's Michael Hassenstaub, moved out of treasuries more than 5 years ago. I will ask him why and where he is investing instead. It turns out he has lots of choices. According to research firm Brandywine Global Investment Management, more than 70% of the world's sovereign or government debt is issued outside the U.S. In contrast, about 50% of the world's stock value is non-U.S. Of particular interest to Hassenstaub is the debt of developing markets, which, as you can see from these charts, is improving dramatically. More than a decade ago, only 2% of emerging market debt was rated investment grade. More than a decade later, 60% of emerging market is investment grade. Hassenstaub's early rejection of U.S. Treasuries isn't the only move that sets him apart. Chosen as Morningstar's 2010 Fixed Income Manager of the Year, he has established an enviable 10-year track record at the venerable Templeton Global Bond Fund of 12% plus annualized returns. He oversees more than $100 billion in fixed income and currency investments at the Franklin Templeton Fixed Income Group and has won numerous other global bond awards, all at the ripe old age of 37. I started by asking Hassenstaub how, given his expectations of rising rates globally, he is managing the global bond portfolio.
You know, there's a couple things. One, we have no U.S. Treasuries, so we're staying away from the markets which we think are overvalued and have a degree of fiscal risk or monetary risk. And we're looking for opportunities to earn a yield, but without taking a lot of interest rate risk or a lot of credit risk. So even though it may be tempting that Greece has a double-digit yield, there's so much credit risk there, we're not willing to take those type of investments. But in places like Australia, where you can buy a 2-year government bond, earn a 5% yield, in a country that has less than 20% debt to GDP, you don't have to take interest rate risk because you buy short-dated bonds. You don't have to take credit risk because they've been well run. And you can position in a currency that is very tied to the dynamics going on in China. So as we go around the world, we're looking for opportunities to buy yield, short-dated assets, without taking a lot of credit risk, without taking a lot of interest rate risk, but positioning for currencies that we think will appreciate against the dollar.
So let's talk about this, because you do look for global values in 3 areas. So interest rates, you just mentioned the 3, currencies and sovereign debt. So take us through each one. As far as interest rates, where are the opportunities that you see in interest rates?
In terms of looking for places for interest rates to decline, very few.
All right.
I think most interest rates are probably about as low as they're going to go. Maybe one or two exceptions in some emerging markets where because the risk premium of those countries is coming down because of good monetary management, fiscal management, there's a chance that long rates actually might come down a little bit further. You know, a place like Indonesia, which is benefiting from greatly improved governance, improved FDI flows, policy management. There are some of those cases, but by and large, I think we can say that the opportunities for interest rates to come down is behind us.
And I should say FDI is foreign direct investment.
Yes, foreign
right?
direct investment.
Okay. And where is the biggest interest rate risk? Is it treasuries? You just said you do not own U.S. treasuries.
Yeah, because we've found often better value outside of the U.S. Than we found in the U.S. Treasury market. Even during the financial crisis, where
they did quite well.
Where they did quite well, we were positioning in markets that we thought would have ripple effects 3, 6, 12 months later. You know, the crisis started in the U.S., but it was our view that it was going to become global. Eventually, countries like New Zealand or Korea or Chile were going to have to cut interest rates to deal with this crisis. So we went long those rates markets as in anticipation of a ripple effect. So in terms of when we would come back to the U.S. Treasury market, we would need to see two things. We would need to see some form of responsible fiscal policy, which at this point we're seeing no signs of responsible fiscal policy.
So you're not encouraged by what you're hearing from, let's say, Representative Paul Ryan or from President Barack Obama and talking seriously, we think, hopefully, about deficit reduction?
What really troubles me is we have $1.5 trillion deficit and the government almost closed fighting over $50 billion. So we're not even tackling the big issues and they can't agree. That is not very encouraging. And we're getting close to an election cycle, so the chances of real serious fiscal reform, I think, are unfortunately not looking very good, despite some of the best efforts by certain individuals and committees. Just doesn't seem there's the political ability to do anything about it.
So you said that was one of two, so the fiscal responsibility in this country, and then what's the second one?
Just valuations. I mean, we're at incredibly low levels. We would need to see significantly higher levels. Also, in terms of the growth path, we actually have a pretty decent outlook for the U.S. economy. You know, whether we grow at 2.5 or 3.5, you know, it's I think a reasonably healthy trajectory. That's usually not an environment to want to go, you know, long duration assets. So we're not seeing value and we're not seeing good policies.
What about the Fed? And you told me earlier that the Fed was behind the curve. What do you mean by that?
We're slightly concerned the combination of fiscal and monetary policy in the U.S. is so aggressive. In fact, it is as aggressive as it was during the heat of the crisis. And at that point, we think it was very appropriate. It was appropriate for the Fed to print money and for the Treasury to spend money and to deal with bank recapitalization, do everything at once and prevent a lost decade like Japan saw. And I think one of the reasons Japan saw a lost decade was they incrementally piecemealed out those policy responses over a decade. And I think U.S. policymakers deserve a lot of credit for doing it all at once. And I think that put us on a trajectory very different than Japan. The challenge I see, though, is that we still have those same policies in place years after the recession and in an environment that is not anything like it was in the end of 2008 or early 2009. So at what point do these super aggressive policies start to create distortions and become counterproductive?
And?
I think we're there.
We're there. And where are you seeing the distortions? Are you seeing the distortions especially anywhere in the bond markets and the fixed income markets?
I think where we're seeing the potential distortions is this excessive amount of liquidity, and that could potentially be distortive to global asset prices. I think some of the rise in commodity prices is a function of all of this printing of money, and it's not just the U.S. You know, European central banks have had incredibly easy policy. Japan has had incredibly easy policies. So you have the three largest economies in the world with the loosest monetary policy on record, and that money is global and it's flowing everywhere. And I think part of the commodity price rise, part of it has to do with strong growth out of China and some of the emerging world, but part of it has to do with this easy monetary policy. And so higher food prices, higher fuel prices, you know, they feed back into the U.S. and they hurt some of the people that are most disadvantaged by this recession. So I think, you know, there are risks that too easy of policy can create long-term consequences. Just think of what we did as a response to the dot-com bubble. Extraordinarily easy monetary policy set the stage for the real estate bubble. So what are we setting the stage for in the future? You know, we don't know for sure, but too easy of policy and too aggressive of fiscal policy seems like a recipe for problems.
So let's talk about currencies, and you manage tens of billions of dollars worth of currencies, and I think some article called you the $100 billion currency king or something, whatever. So tell us about which currencies do you favor? Where are you long? Where are you short?
The currencies that we like tend to have a couple characteristics. One, they're in countries that didn't have an over-leverage problem. So they're countries that had a sharp cyclical decline because of the global collapse, but they've had a sharp cyclical recovery. They're countries that have had prudent fiscal management, so they have constrained debt to GDP.
I'm hearing a theme here.
Yes. And they're countries that are raising interest rates with a good policy mix. They're staying ahead of the curve, they're not behind the curve. And that's a range. That includes some developed economies like Australia or Sweden or Norway. It includes also some emerging markets like places like Malaysia. I think places like China are doing a reasonable job of being proactive. So a lot of the emerging market currencies we favor against the dollar, euro, and yen.
One of the things that changed in your portfolio, evidently from 2007, to now, starting in 2007, was that at one point you actually had overweights or you favored the developed markets, and now you are favoring the emerging markets. Is that an accurate statement of your position, and why has that happened, if it is?
Yeah, so going into the crisis, we had large positions in things like the Swiss franc or the yen as a hedge against global risk shock. As the crisis unfolded, emerging markets got hit very hard in terms of their currencies weakened, spreads widened, there were a lot of distortions. Our view was that these economies were actually far better run than they had been over the last decade. I think good policies, really since about the time of the Asian crisis, are paying dividends. Countries have had good fiscal management, good monetary management, built up reserves, and that allowed them to weather the crisis, but also set them up for what we think will be, a good run in the future. And so, yeah, we are favoring a lot of the emerging economies where, we can earn a good yield. They're in countries with low levels of debt, strong growth,
high savings.
That should do well. High savings,
right?
Yeah.
So it's interesting because I know that one of the things that you've been negative on is the yen, and since mid 2009, and needless to say, the yen has performed quite well, especially recently. So what's your view of the yen?
What concerns us about the Japanese yen and why we think it'll be weaker over time is Japan. Even before their horrible crisis, but certainly as a policy response to the crisis, is going to need to keep incredibly easy monetary policy. They're going to have to print even more money than the Fed is printing. They're going to have to run looser policy than what the US will run. I think US growth will outperform Japanese growth, and eventually US interest rates will be higher than Japanese rates. And those relative differences of growth, interest rates, and the ease of policy, I think ultimately will take its toll on the yen and weaken it. And one of the things Japan actually needs as part of the way to recover from this crisis is a weaker yen.
Right.
And we saw that with the international coordination of intervention to prevent it from going below 80. So you have policymakers putting a line in the sand, and you have the macro fundamentals setting the stage for a weaker yen.
You mentioned the Eurozone, and so you would be short the euro, is that correct?
Versus not the dollar, but versus some of the Scandinavian and Central European countries.
All right, so that's a big difference. And then there are some currencies in Europe that you actually favor. Well, you just said, the Norway krone, the Swedish krona, right?
Yeah.
Swiss franc.
Not so much the Swiss franc, but definitely Scandinavia.
Right.
We like,
and
also,
Poland.
Yeah,
right?
Also Poland or Central Europe. The things we like there, Poland, one economy in Europe to go through the financial crisis without a recession. Here's a country that has more conservative debt accounting standards than even core Europe. So if you use an apples to apples accounting measure, they have far less debt to GDP than most European countries. An economy that's growing, an economy that has a skilled labor force with low costs, competitive taxation. And so they are benefiting from all of those factors. They're also benefiting from their linkages with Germany. As German exports boom, a lot of those inputs come from Central Europe. And so the better German exports do, the better those economies do. So it's both on a standalone basis, we like the macro fundamentals, but we also like their role in the global supply chain and the global export story that eventually is feeding into Asia.
Talk to me a little bit about the challenges that you face, because what are the biggest challenges you face this year, for instance, and maybe next year, that are quite different than what you faced, let's say, in 2010?
I think the big challenge and the key thing for us to really spend a lot of our research time on is assessing the policy framework and the policy reactions of different governments. If the US is too loose or gets behind the curve, that is going to export issues to the rest of the world. The US exports monetary policy to the world. If other countries don't react proactively to both their domestic conditions and this importation of capital, if they get behind the curve, that could be very distortive. So I think we'll spend a lot of time looking at which countries are ahead of the curve, which countries are behind the curve, what are the tools that countries are using. And so far, we're pretty encouraged that I think most of the world, non-Japan, Asia, a large part of our exposure there, they are staying ahead of the curve. They are allowing exchange rates to appreciate. They are
raising interest rates,
and they're cutting their fiscal expenditures. I mean, all three of those, that combination, I think, is the perfect policy prescription. So it was very hard for a lot of policymakers, I think, in Asia to lead the Fed. In the past, a lot of Asian economies followed what the Fed did, and now they had to take the lead because of the relatively different conditions. There initially, I think, was a hesitation at that, but now I think they have taken that lead and are doing the right thing.
So how about making some calls here? So what would your big call be for 2011 as far as your investment strategy and what you're going to favor?
I think one of the big ones would be our overweight on a lot of emerging market currencies versus the euro, yen, and dollar. Mm-hmm. I think the other one would be on being very defensive with regards to interest rates. So not having a lot of long maturity bond holdings would probably be the second big thesis behind our portfolios right now.
So even in the sovereign credits or in the government bonds and the currencies that you favor, that you still have relatively short maturities and durations in your portfolios. And that is just to protect yourself against the global rise in interest rates? Is that what it is?
Yeah, that's correct. I mean, even in countries that are doing well and don't have a lot of debt, if they're growing and they're facing inflationary pressures, they're going to have to be raising interest rates. And so we want to protect against that dynamic. And the nice thing is you can buy some short-dated bonds, and as they mature, you roll them over at higher rates as they keep raising interest rates. So generally, that is our strategy: buying short-dated assets globally in countries that are raising interest rates in currencies that we like.
How much do you try to look at currencies or bonds that are being battered and that are definitely unloved? Is that part of your strategy, or would you just rather avoid those things?
Yeah, we like those situations.
All right. What's being most unloved and most battered now that you think represent opportunities?
I think there still is an undervaluation of a lot of non-Japan Asian currencies. I think there usually come opportunities like what happened during some of the Mideast crisis. It had ripple effects in terms of market contagion. The Australian dollar sold off because of what was happening in Libya. Reality was, that there really wasn't a linkage there, and so it was a market sentiment issue. And so in those opportunities, we like to take advantage of those sell-offs and add to our positions. So we do like to try to be contrarian, but sometimes the market is selling off for very good reasons. We don't hold any Greece because there are certain situations where they're just insolvent, and even though they're offering attractive yields, we don't think there's value there.
And as a bond investor, how do you take advantage of the growth in China? I mean, is there some peripheral trade or linked trade that you can make? Because China, you can't really buy their government debt.
Yeah, that's exactly right. Is looking for how is China going to affect the rest of the world?
Right.
In some ways, maybe it's a bad analogy, but you think, how did you make money in the gold rush? It wasn't by buying gold, it was by selling shovels and looking at the linkages of what that dynamic was driving. In much the same way in China. Chinese growth is driving huge demand for Australian exports or Chilean exports or Malaysian exports. Chinese capital flows going abroad, moving into emerging markets, are boosting investment in those countries. So we are looking for countries that are really linked to China and benefit from that. We also have a belief.
So you mentioned Australia being one.
Yeah,
you just
Australia.
mentioned, right,
Yeah,
Indonesia, Malaysia.
A lot of Asian countries are
Right.
going to be highly tied to China. The other way is our belief is that over the next 10 years, the Chinese yuan will become one of the global currencies. It will become an international reserve currency. It's not going to usurp the dollar, but I think in 10 years it'll be dollar, euro, and Chinese yuan, probably as the big three. As a result, in order to achieve that, China needs to open up its capital accounts, and in doing so, their appreciation pressures will likely appreciate the yuan. So yuan appreciation, that is another theme, and that will bring a lot of other Asian currencies with them. So our belief that the yuan will become a global international currency motivates some of our overweight in some of the other Asian currencies as well.
So the dollar status as the world's reserve currency, how secure is it?
I think the days are over where the dollar is the only reserve currency. I think the dollar will still be probably the most important and the largest reserve currency, but it will have to share the stage with other global currencies, particularly the yuan. I think the reason for that is we're going to pay the price of irresponsible policies, particularly the massive amount of fiscal spending. The US has enjoyed an exorbitant privilege, which is we can kind of get away with the rules of economics because everyone had to buy our assets because the dollar was the reserve currency. But if we share that stage with China and with Europe, then there aren't these forced buyers, and the repercussions of that are probably higher interest rates in the US. So I think ultimately there is no free lunch, and you have to pay the price of your policies. The US has had a lot of cushions and been able to get away with a lot, but ultimately I think we have seen the end of a world which is a single reserve currency, which is the dollar.
And let me ask you about how damaging a transition could be, and the fact is, I mean, you're a global bond investor. You talk to other countries all the time. You're aware of how quickly money can move back and forth. So, I mean, how much danger is there of our foreign holders of our currency? I mean, the Japanese, the Chinese, the Russians, for instance, of diversifying out of the dollar quickly, which would result in our interest rates could go up much faster than we anticipate.
Our base case is that this is actually a pretty gradual process. We wouldn't expect massive dumping of assets because what needs to happen for the dollar to no longer be the only reserve currency is you need the rise of the Chinese yuan, you need Europe to sort of stabilize. And actually, if you look at the dollar relative to Japan and Europe, it actually looks pretty good. But when you're looking at the dollar relative to the rest of the world outside of Japan and Europe, it's not looking very good. So really the dollar, I think, will be increasingly bifurcated. I think it could do actually pretty well against some of the other developed markets, but do very poorly against a lot of the emerging markets. So in that environment, we don't foresee a dollar crisis, but just a realignment and really a revaluation of a lot of the emerging markets against the dollar.
So final question, we always ask each of our Wealth Track guests, what's the one investment that all of us should own something of in a long-term diversified portfolio?
I think there is too much of a home country bias in a lot of investors' portfolio, which concentrate risks and limits opportunities. So whether that be in fixed income, whether that be in equities, whether that be in alternatives, a global allocation I think would be my recommendation for investors to be thinking about how to optimize their portfolio.
And just to dig a little bit deeper on that, should it be an actively managed portfolio or an index fund, for instance? I mean, are we going into a period now where we need active management?
The problem with index, for example, in the global bond space, the index is comprised of the highest indebted countries. So do you necessarily want to buy the worst credits or the largest debtors? No, I think you actually want to be investing with those that have run prudent fiscal policy. So when you buy the index in the global bond space, you're buying the most indebted countries. What was the largest emerging market country in the emerging market index in 2000? It was Argentina. So did you want to buy Argentina? No. What's the largest weighting in the global bond indices today? It's the US, Japan, Europe. Do you really want to be allocating to those? So no, I think it is important to be active. So I guess there is a caveat there, go global, but do it in an active format.
Well said. Michael Hasenstab, thank you so much for joining us from the Templeton Global Bond Fund and others.
Great, my pleasure. Thank you for having me.
Of course, picking the right active manager makes all the difference which is why we have identified Michael Hassenstab as one of the new generation of great investors. Next week, we will have an exclusive interview with one of the established generation of great investors, and in this case, a financial thought leader to boot. I will be sitting down with Paul McCulley in his first television interview since he retired as senior partner at PIMCO, where he headed up the short-term trading desk, was a member of the investment committee, and was its widely followed Federal Reserve watcher. That will be fascinating. In the meantime, to watch Michael Hassenstab again, please go to our website, wealthtrack.com, where you can see it as a podcast or streaming video. And while you are there, you can watch my extended interview, yes, the unedited version of my conversation with financial thought leader James Grant of Grant's Interest Rate Observer. Thank you for visiting with us, and make the week ahead a profitable and a productive one.
Additional funding provided by Loomis Sales, investors seeking exceptional opportunities globally. Research Affiliates, an efficient index for an inefficient market. Wintergreen, your home for global value. Rosalind P. Walter and the Dreamin Foundation.